For most of modern financial history, markets were anchored to something real. Things like corporate cash flows, quarterly earnings, and economic data. Even when markets went through intense manic phases, like the explosion of internet stocks in the early 2000s, fundamentals eventually showed up. You could ignore those metrics for a while, mock them, or even build a bubble around them. But as the 2008 banking collapse proved, a system built on bad data eventually corrects itself. There was always an unspoken belief that value investing, pricing an asset based on its tangible financial health, sat at the foundation of markets. Those numbers acted like gravity, constantly pulling prices back to reality. Since 2020, that gravity has vanished. The old story of buying quality companies at fair prices has been replaced by the assumption that every dip is a gift and stocks only go up. Take Michael Burry. He famously profited $800 million from his bet against the housing market in 2008. He is the human embodiment of trusting raw data and ignoring the noise. Recently, he shut down his hedge fund. In his own words, he stated, "My estimation of value in securities is not now and has not been for some time in sync with the markets." His traditional math models stopped aligning with current prices. When the investor who built his entire fortune on trusting fundamental data can no longer calculate a stock's value, it forces a deeper question. If raw numbers aren't driving prices anymore, what invisible force actually is? While traditional finance assumes markets are rational calculators, behavioral finance starts from a different premise. It assumes markets are entirely human. Back in the late 1970s, psychologists Daniel Kahneman and Amos Tversky pioneered this field. They showed that humans consistently fail to evaluate risk objectively, that we fear losses more than we value gains, and that our emotions and crowd behaviors actively override objective analysis. For decades, traditional Wall Street mostly brushed this psychology aside. They treated it as a fringe theory, useful only for explaining the occasional emotional panic, rather than how daily trading actually functioned. That dismissive attitude worked when trading was slow. But that psychological theory was about to meet a technological shift that would turn it into the market's primary driver. In the past, human behaviors like herd mentality were constrained. Information moved slowly, participation was limited, and trades took time and money. Today, zero-fee apps and widespread retail access have stripped that friction away. Social media collapsed the market's timeline. A digital news catalyst directly links to massive capital deployment in seconds. Execution volume spikes purely from news sentiment, while corporate revenue stays flat. This zero-friction pipeline lets crowd excitement instantly bypass intrinsic valuations. Major institutional firms have abandoned pure mathematical inputs to survive, pivoting to scrape Reddit and model online sentiment analysis. Finance now operates as a reaction engine for social networks. The market now prices online momentum and human attention over actual balance sheets. This creates a dilemma for anyone deploying capital today. We have 5 straight years of evidence showing psychology overpowering numbers, but history suggests this might be another emotion-driven bubble. If the bubble theory is true, then sooner or later gravity will return. When it does, it will violently correct prices back to their measurable reality. But there is a second possibility. The removal of trading friction and the dominance of instant communication may have permanently altered the market's mechanical inputs. If this represents a permanent structural change, traditional valuation models are effectively obsolete. Investors must accept that digital crowd psychology is now as financially powerful as corporate revenue. The compass needle has locked into a new, fixed direction.